Hello, everybody, and welcome to another Pepperstone Learn It Live webinar. Today is, of course, the 24th of February, and we're coming to you today to talk about 3 swing trading strategies for part-time traders, a topic very close and near and dear to our hearts. We love swing trading strategies. I hope that you guys do too. So today, of course, my name is Thomas Atkinson. I'll be joined by Tyra and Abella very, very soon, and this is a Pepperstone Learn It Live webinar that we've been doing now for the last couple of weeks. I just wanted to make sure that everyone can hear me. If you could post that in the room just to make sure that we do have sound, that would be great. And then we'll get started. So a lot to go through today though. There's some excellent things that we are going to be seeing. One second, I'm just testing the sound. Perfect, it does work. Thank you very much. All is good. All right, guys, well, let's get started. Before we do though, there is a quick risk warning. The information contained in this video is generic in nature and for educational purposes only. The information does not take into account your personal objectives, financial situation, or needs, and this information is not to be construed as an offer, recommendation, or solicitation to buy, sell, or participate in any particular trading strategy or investment advice. So as we always do, we always talk about Pepperstone's Telegram group, and obviously we have a Pepperstone YouTube channel, and we're from FX Evolution. We also have a YouTube channel. We do encourage you to check out all of the things. I've put in a link to the Telegram group in terms of you can now link to that and join up to it if you want to. It's free, and Pepperstone update every day with helpful bits of information about the markets, including stock markets, forex markets, commodity markets, etc. It's a really great tool. It's been running for quite some time now, and there's a lot of people involved in it. So it's incredibly consistent, and that's what makes it a great group to join. So what are we going to be covering today? Well, we're going to be covering 3 different swing trading strategies for traders out there. Now, I particularly like swing trading because it's great for part-time traders. If you're somebody that doesn't have that much time and you say to me, Tom, I don't have that much time. Look, I work during the day and I've got half an hour to 45 minutes, but I want to make it as a trader. Swing trading is going to be for you, and we'll discuss the different types of trading and the way and how long you're generally going to need to hold them as well. We're also taking a look at the live charts and price action analysis. I've got some great examples that we've seen over the last 24 hours, and I've also got some good examples moving forward about talking about structure of candles, structure of the market psychology, and then a movement. Of course, a lot of our stuff is based on price action, and then we bring other reasons together to form a thesis or an idea of what's going to happen next. So we're talking about key entry points on smaller timeframes and what we look out for, and then of course the Q&A at the end. Question coming in here saying straight away from Michael. This is, I love swinging, smiley face, but I'm not sure if it suits the current market conditions, volatility, but can change really quick. Yes, so what you're going to notice when you're a swing trader is that when key resistances and supports are broken through. So let's say you had a market. I'll actually draw this because it's a great question straight away, and I think this will answer quite a few of people's problems with swing trading. So let's say you're in a range-bound market. We've identified it as a channel, and the structure forms like this. When the market breaks and closes, let's say below, we can pretty much say that something's happened fundamentally in the market, and this tends to be where you begin swing trading it in that direction. Channels, range structures, this type of thing is what you usually look for. And you need to think about the market you're trading. Now, the stock markets around the world, highly volatile right now, but there is still opportunity. Bitcoin, there's still opportunity. Crypto markets, always, you can find good swing trading in that. And then you've got some really great swing trading in currencies. Because remember, currencies have no real big long-term value. It's more of a floating value, and they don't have a clear direction all the time. So when they start swinging and they go into a direction, it can often be 1, 2, 3, 4, 5 cents long, maybe 10 cents long, and there's a lot of opportunity there. Tyron, do we have you here? I thought I heard him. I think he'll be here. He's just got some sound issues coming through. Which trading pairs are best to start with for swing trading? So look, sticking to the majors is going to be the easiest way for success moving forward. Gold, gold US dollar, gold odd, gold euro, all of these types of pairs, same with the silvers. If you actually take them to the other denominations, gold pound, etc., you'll actually find they give and present different opportunities and different patterns. So sometimes you might be able to actually take a short on gold odd but it's different to gold US dollar, which is in a holding pattern. And that's the beauty of checking out some of these crosses. US dollar majors as well, odd US dollar, euro US dollar, US dollar yen, pound US dollar, all of these are excellent starting points. And as we've always said, the majors, the top kind of 8 currency pair trading in the world, usually versus the US dollar, are a great point. Then there's things like euro pound, also a great technical. I'll show you one and how you could have taken advantage of that recently. Euro yen, pound odd. This all comes down to the time frame that you're going to be trading. So we probably have a lot of Europeans out there, a lot of Australians right now, maybe some people in the US. I know it's very, very early though. But basically, if you're trading euro pound, when is that going to be best? Around the European and London trading times. When is euro yen going to be best? Probably the Asian session into European and London trading times. And the pound odd, it's actually very good around the start of the Asian session open. So if you're trading the Asian sessions, you might want to have some more yens and some more odds in your criteria that you select per day when you're doing your scans. Just things to think about when we select what type of trader we want to be. Are we recording this webinar? Absolutely, and we will update it to the YouTube. So remember, follow Pepperstone on YouTube and you'll be able to view it. Cannot hear you still talking. I should be working. If you have any problems with the audio, just rejoin. If you're on the web browser, rejoin, it should work for you. So times to trade for part-time traders. Remember, we need to select scalping, day trader, or swing trader. Today's all about swing, but I want to denominate the differences. If you're a scalper, you really have to put in the work. And what I mean by that is I think you need to dedicate 1 to 2 hours a day consistently all the time to be a good scalper. Why is that? You've got to be around for the market opens. You've got to select a period that you're going to be excited for. Let's say it's London Open, and that period that you're consistently looking at, learning the way that structure moves. And if you're a scalper, you generally don't want to have too many pairs. Swing trading will allow you to have a lot more. So a scalper may only have 5 to 8 pairs that they look at. A swing trader might have 20 to 30 pairs that they look at, because you can do much quicker scans, and you're going to start your scans on usually daily and 4-hour time frames. So what's the best time frames for a swing trader? It's going to be daily and 4 hours. They are usually the best time frames. Now, a day trader, traditionally what you're trying to do here is you're trying to get in and out within a day. Are you going to be able to do that with your busy lifestyle? These are the questions we must ask. So times to trade for scalpers and day traders, generally 30 minutes to 1 hour before and after the market sessions open. Usually things set up into London around half an hour before. So you'll start to see key resistances or key supports getting tested before that open session, and often broken into the first hour of the session. That's why that's the time to trade if you're going to be a scalper. But for swing traders, you only have to check the time twice. So 1 to 2 times per day is all you need to check the charts. And that's just such a benefit for so many people. If you only have to check it, let's say on the daily close, and maybe when you get alerts, or you've got an alert saying your stop loss is getting reached or your take profit is getting reached, and other than that, you're not looking at the charts, that's the benefit of swing trading. We want to look for daily candle closes to give us criteria. We'll see that very, very soon. And we want to target the major currencies, indices, and commodities. So how do we do this? How do we go with our first strategy for swing trading? Well, one of the ways is going to be top-down approach. Start with the highest time frame you are looking at, and then we want to work down. Once we get the higher time frame, usually you'll probably start around a monthly or a weekly, you get an idea of what's happening in the markets, and we'll do that together very, very soon. We also want to recognize whether the market is trending or it is range bound, as if it is range bound, it may not open itself so much for swing trading, and we need to trade more within that range or within that structure. We might bring in our range bound market strategy, and you will have multiple different strategies. You'll have one to do with your trend. So you'll have your trend based strategy. You'll have your range bound based strategy. And then funnily enough, you may also have a strategy that is don't trade the market. Sounds strange, but this actually is one, isn't it, Tyron?
Absolutely, absolutely. Yeah, welcome everyone. Yeah, had a few technical issues on my end, but look, that part that we just talked about there is probably one of the most important things. Recognizing
Yes.
which market you're in and actually working on the strategy that's actually going to suit that particular market is vitally important to your success. Because even the most strong of strategies will not work in the wrong type of market. So if you are not familiar with what we're talking about there in regards to trending and range bound markets, we really encourage you to go through some of the previous Pepperstone webinars that we've done that explain that right through. It's a very, very important aspect of actually being successful and identifying which strategy is going to work well. It makes all the difference, doesn't it, Thomas?
It certainly does, Ty. Recognizing the trend, recognizing range bound markets, doing a top down approach. If you're not doing that and you're a swing trade method, it's just not going to work out for you. I've got a question coming in here, and Michael says, my problem is I analyze swing trading, but I trade it like a scalper. We've all been there, Michael. Don't worry.
Yeah,
Get out too
very common.
early, which is more of a psychological issue, which I'm working on. Look, it's a totally normal thing. And I can assess if you want to be a swing trader and you're recognizing the key areas and you are getting in the correct zone, taking it out too early, yes, you have to work on your psychology. One of the ways you can do that, let's say you've got your live trading account, you could always open a Pepperstone demo trading account, trade in that one, and let the trade run. Let the trade, we do this all the time in mentoring, let the trade run to what your theoretical take profit is. How hard is it going to be to leave a demo account to let it run to those zones? Now, if you recognize at the end of the month or when you do your analysis of your trades, imagine if that account's beating your main one, it's going to help your psychology. So that's a top tip that I have used and I've seen many, many people use over the years that does help. Swing traders and top-down approaches also will need to use line, bar, and candle charts. So we need to use all of them. Let's actually go into the charts here, Ty. Recognizing price action, as Tyrone mentioned, we talk about peaks and troughs. Go on Pepperstone's YouTube. You'll see a whole bunch of videos we've done about that. But we're going to actually look now at the live markets. And I want to show you some things that we've seen recently and how to spot some good stuff. We'll go with the Bitcoin first. Now, you don't necessarily want it. You may not want to trade Bitcoin. Maybe it's not your type of thing. It's not so much about that. Remember, this is an instrument that is tradable that has technical analysis on it and has the ability for you to start analyzing the charts. Now, when you're talking about, let's say, an overall uptrend, if we go to a monthly, it's pretty clear that this thing is incredibly long at this stage. I mean, it almost looks terrifying, yeah? And from a technical analysis perspective, you may be saying, okay, I want to swing that on the way up. Now, it's very aggressive both ways. So there's very difficult for us to maybe pick a zone that we're excited about getting into. Generally speaking, you'll look for structure on the left-hand side. So where a market has found resistance before, and that resistance will become support, and you'll usually have some form of moving average. But with something like an aggressive fall off, like has happened over the last couple of days, we need a little bit more. And I think that comes down to understanding candles a little bit better as well, doesn't it, Ty? What have we got going on down here? We're on a 4 hour, and instantly I recognize multiple weak rejections off this area. And this area here is around that 45,000. Every time it came down there, it was met by aggressive buying on the 4 hour. This aggressive buying means that there is clearly some form of accumulation or heavy support here from, in crypto, they call it the whales, Ty. The whales are in here. But what do you think
Yeah.
about these particular candles? They look good, don't they?
They do. And really, understanding candle structure and what the candle's trying to tell you is vitally important to understanding the momentum and the shifts in the market. Now, yeah, looking at these 4 or 5 candles here, you can see they're very long wicked. So at some point throughout that candle, and this is a 4 hour chart, for every one of those candles, for the space of 4 hours, the sellers were absolutely trying to push that price down and really continue that momentum down. But in every single instance in this chart, the buyers have been able to kick back up and not only reverse all the sellers' momentum, but in a couple of the cases actually take it up higher. And that's really showing a big shift in momentum from the buyer's perspective, because the sellers have failed in their endeavor to push the price lower. And by the end of the period, the buyers have taken control and completely reversed all of that negative action.
They've completely reversed it multiple times, Ty, and it comes down to a story that it's telling us. Rejections, rejections, something's going on. So when you do a top-down approach, you see each one of these candles. Now, this may have been the daily. it was once the daily. If you go look at Bitcoin around 10,000 a few months ago, seems like an eon ago now. But when you look at it, yes, there was actually a very similar type setup. So this is very much characteristic, I guess, of Bitcoin and the way it trades. Let's have a look at the 1 hour and just think about the structure again and what it's telling us. And this is just a good little hint when you're talking about picking up on maybe some form of role reversal in swing trading. I guess we'll call it our first top tip of the day. And that is that you see the structure, the wick buying, you see a big engulf candle come here, but then notice all of these little wicks above. We don't have a close, but then all of a sudden we have a little bit of a sell-off followed by some massive bullish aggression. What is this, a pin bar or a hammer candle straight into the resistance? There is no close above this zone at that point. So this is telling us that if we get a little bit of market momentum above here, especially if we get a closed candle above here, that we are moving in the right direction. We've formed the structure underneath. It looks like the bottom's in. The 4 hours telling us that story. The 1 hour is telling us that story. Even this candle is telling us that story. And it's time for us to move to the next area, being like a 52,000. Why do we think that? Because this is previous level of support. And then if we get through there, then we move to the next level, et cetera, et cetera. So it's understanding the candles a little bit differently than you may normally do them that I think really changes the game. Think about the candles, think about the psychology in swing trading.
Yeah, I think it's really, really important to focus on that point just for a second, because a lot of people say a question we get asked probably 100 times a week is, which indicator should I use that's going to give me the most amount of information that I can use every day? And the truth of the matter is, it's candle action that gives you the most important information, because that's actually the here and the now. It's probably the most important indicator there is, because price action is essentially a leading indicator. Like most indicators, as you're probably aware, are lagging. They're using previous information and history to plot the next move up or down, whereas price is giving us the information in the here and the now. It's absolutely giving us the most up-to-date information that we can use. So that when you think about that, it's really, really important to understand price action, and that's going to come from candles. So understanding what the candles are trying to tell you is probably the most important lesson that you can learn in technical analysis, because it is the one true leading indicator that there is out there.
It is the one true god of indicators, isn't it, Tyron? So
Absolutely.
One of the things that we'll talk about today, reading price action as actually a trading strategy. Now, the trading strategy really here is understanding that the top-down approach gives you that information. It gives you rejections on the 4 hour, it gives you structure on the 1 hour, and then you see even better levels over here on the right-hand side. So we'll come back to the live charts very shortly, but we'll go back in here and just talk about a few different types of systems that you could bring. So one of them for a swing trader is you work out a channel. And when you work out a channel and it breaks, you can start or begin to take swings. So what you can actually do is that a channel should take this distance here, which is A. That should be then extrapolated out, which is B, but it also can be the beginning of a new trend. So oftentimes the market will pull back, move forward, 2 steps forward, 1 step back, 2 steps forwards, 1 step back. And your ideal situation is taking the pullbacks and taking them in the direction of that new trend. So channel breakout strategy is actually something that I would add into your overall concepts so you can recognize those range bounds and the beginning of the movement. Again, understanding the structure is the key. Then there's the traditional one, which is moving averages, trend with the role reversal. That's where we have the movement up, we have the pullback at the same time. There's moving averages here, we have the movement up, the pullback, previous resistance becomes support, Tyrone, and we have the moving average at the same point. How much of this type of trading do we do?
It's our favorite, and anybody, I know a lot of you in here are in our Discord room. We talk about this all day, every day, and most of the trades are based around it. Because why? Because generally you can find a situation like this on an everyday level, right? So if you're looking at a daily chart and it's looking a little bit sideways, for instance, you only have to go down to, maybe a 1 hour chart or a 15-minute chart, and you're going to see this exact action. So, and this is why it's important to understand your time frames, because if you see, a market could certainly be going sideways on a daily chart, but have really nice trends on a 1 hour chart where you're going to get these opportunities and you're going to get the pullbacks to the moving average. So that's why I think it's really, really important to understand what you're, trying to achieve and having a different strategy for the different situations, because it really opens up the door to many, many trading opportunities on an everyday level across the many, many pairs that you can trade.
So the moving averages are important. We've got a question here about which ones we use. I will bring that in just a few moments, don't worry. But the moving average trend with role reversal, a standard play in swing trading. The kind of, I guess, the pie and chips, if you want to call it, the most basic one that you definitely want to have. Then we have what I will label the 1, 2, 3 system, and you'll see what the 1, 2, 3 system is, but it can actually be like the 1, 2, 3, 4, 5, 6 system. It can be a whole bunch of different things. These three, I think, all work quite well, and they work hand in hand to give you different entry criteria that will all pretty much achieve what you're looking for when it comes to part-time trading and swing trading. Remember, we want to try to focus on those daily 4 hours for our alerts. And then as Tyrone mentioned, we can even scale into the 1 hour, 15 minute once we get the alert that says, okay, now it's time for us to enter. And we go and look at the structure on that time frame, enter our position, put our stop loss in, put our take profit in, and we're kind of off and done. So here's a channeling market. This is the traditional kind of way that you look at it. We go through that all the time. You've also got double bottoms, a good way of seeing the end of trends and start of new trends. It's important for us to be able to spot these, because when we do, we can then get involved in the swing in the new trend direction. So all of these types of things are really great for continuation. You can often see these types of things as well into the swing base, into the ability to take things into the direction, specifically ascending triangles, flags, pennants, symmetrical triangles, all of those are well worthwhile. Role reversal, we've said this so many times, I think it's worthwhile going over in the YouTube if you haven't seen it before, where resistance becomes support. And then we have, after that, the role reversal on the real market. Now, this is actually what I call a 1, 2, 3 here. So what we have is we've got 1 touch resistance, 2 touch resistance, 3 touch resistance, and this is the 1, 2, 3, 4. So we've got the 4th touch, 1, 2, 3, 4. Now, when we have this many touches to the resistance line, what do we think happens if the market comes back and tests that area? That point of resistance will become support. It'll become a heavy demand area. And then there are some things here and some hints that we can go into the price action. What did we say before? Wick rejection candles on significant time frames, such as the 4 hour, are showing us the buying momentum is here at this point. If there's buying momentum, somebody really wants it at that price. So clearly there's demand there, and the demand hasn't broken through yet, but the trend was already up coming into this point. It's more likely, considering that demand, considering the 1, 2, 3, 4, maybe a moving average as well. All of those things together give us a very good technique to take it in that direction of trend. And in this case, it would be, of course, long or bullish. We don't want to be FOMOing and swing trading. When you're a part-time trader, the worst thing that can happen is you get into scalps, you have a bad night on the scalping, you take 2 or 3 losses in a row, and you go through this. And I've shown this so many times over the last year, Tyrone, I feel, but it's just because we've all gone through these 14 stages of trading psychology. I think Michael's probably gone through it as well. Not to single you out, Michael, but we all have. And this is where you maybe get a little bit of fear, possibly because of things that have happened in the past. You go through all these ones. If we could be this, a horrible robot, if we could be the neutral robot in the middle, you would actually be a great trader. Because what would happen? You have no emotion. Now, we don't want to have no emotion in life, but as a trader, we want to try to stay as close as we can to the middle, to literally just a standard kind of everything's just, yes, that's the next trade, let's move on. Treat it like a business. It's boring, but it's the way to do it. So we don't want to be FOMOing in that market. Let's go back now to the live markets, Tyrone, and we'll have a look at a few other things that have happened recently that I think are pretty important. One of them being this one here, which is the pound US dollar. So I wanted to firstly show how important it is to recognize 1, 2, 3 kind of levels and when resistance breaks. Now, if you were, let's say, looking at this and you said, okay, I like this zone and I'm looking for a pullback back to this zone after it closes above, that would be an incredibly valid swing trading method. That's where it goes like this, pulls back, moves back down to this zone. There'd be a 50 exponential moving average, the blue line. So that's one of the moving averages we use. The 20 exponential moving average is above, which is the red line, and the 200 simple moving average. So they're the three that we use here. But if it came back to this area and you were waiting there with an alert and you were a part-time trader, that would have been an excellent type of entry. We have 3 touches to the top, if not 4, and we know that there's a moving average here. There's probably a Fibonacci pullback, all those types of things coming together. And what an excellent zone. Now, it didn't happen, but the point is that if it did happen, it's a great area for you to be targeting. And all you had to do was come in, put an alert for when it closes above here, put an alert for this zone. That's it. It's 5 minutes of work, not even. More time setting alerts than looking at the charts. Ty, what do you think about that?
100%. And the thing is, when you do that, you're far less likely to make mistakes. What a lot of people do, one of the most common mistakes is probably missing that initial entry and then just trying to jump on board. What we implore people to do, if you do miss that initial entry, is identifying that it has broken out. No question about that. If you wait for, so let's say for instance, you're entering, at the first level of the 20 moving average, hasn't come all the way down to that point where you've got your entry, and then it takes off from there and you're like, oh wow, I've really missed it. The idea is not to just jump on board, okay? You don't want to be jumping on a moving train, but what you do is wait for the next touch of that zone. Remember we talked earlier about once a trend is in motion, you want to be entering on the pullback. So what you're doing is effectively waiting for the next pullback. Now, sometimes you're going to get a better entry, sometimes it's going to be a little bit worse, but what you are getting by doing that is actually confirmation that the momentum is in your direction. That's the most important thing. When you enter a trade after it's hit a level and you've missed that level and you're jumping on a bit late, you're opening yourself up to potentially getting a pullback the minute you actually enter, which is a really disappointing thing. And there's actually a question in the room that actually just says that every time someone enters the trade, it goes negative against them, and it really gets them doubting their strategy. And that is often the case because, and FOMO, those 18 faces that Thomas keeps presenting, is part of the reason for that, because you don't want to miss out on that trade. You might have been waiting for a while, but if the trend is strong and it's going to be, going for a little while, or at least to an expected next resistance level, there's plenty of pips to be had moving forward. It's very, very rare that a trend just goes straight up in a straight line and doesn't come back to a decent pullback. Wait for the pullbacks because it's always a more quality entry. Don't forget that a healthy trend is one that comes back and does a 2 steps forward, 1 step back approach. Okay, it's always better to have a trend doing that than a trend going straight up in a straight line. Sometimes they're the ones you don't want to be involved in because the lashback can be very, very extreme.
So here's an example in the Euro US dollar right now, Ty, and this particular one has a clear resistance through it at 121.80. Now, it was clearly going to be resistance for some period. I mean, you see what the market's doing right now. It's having a movement above. Now, is the trend on the 4 hour in the direction up? Yes. Has it been going up for a while now? Yes, but it's had that tumultuous time. But we aren't through yet. And Tyron and I call this different things. Some of us call it green sky above, and some call it blue sky above. I only call it green because green is potentially the color of money. But when we get through this area and we close above, what's going to be triggering at this point? Well, we're triggering previous resistances and supports becoming an opportunity. But we're also looking at a very key zone where basically if you move through that market condition, it hasn't had a traditional stop after that point. So what I mean by that is it stopped up here, it stopped potentially here, but there's a lot of opportunity for this to make a move and add to what we call the participation phase of the market. So we're basically in the participation phase. It pulls back down to the 121.80, potentially finds some form of support. Maybe we have a moving average of an hour or something hitting it at the same point, and then it bounces back up. So it's the type of thing that you're looking for as swing traders. And I'll go over to the Euro Pound really just to emphasize this point through. Where is my Euro Pound? Let me just quickly bring it up. There's the Euro Pound. And I want to emphasize a key break here that happened. And this happened a little while ago, not too long ago, but look what ended up occurring. We see the close below the previous support levels. This signals that we can now move the swing in the participation phase and get involved in potential shorts, at least down to the next level. Now, did that happen? Yes. It continued down here. Now, is this one of the take profits that you would have had over the longer term? Sure, the longer term trade, you could have gone all the way down here, but you would have had to be in it for quite a few days. That's what swing trading is. You generally will be in something for quite a long period of time. But we can also get involved in the trade throughout this session. So maybe we look for a moving average, and we look at a moving average continuing that trend down. 50 exponential moving average here, the blue line on the 1 hour chart. Every time it hit its high, it acted as dynamic resistance, and there were so many great trades to fill that area, weren't there?
Yeah, we could show you 100 examples of where this happens, effectively on a daily basis. But the key to understanding especially when a trend is moving very, very quickly, as we just saw, going back down a time frame or maybe 2 time frames is where you're going to get your opportunities. So I think that what Thomas was effectively saying is understanding the difference between being a swing trader and a scalper is very, very important, because you need to understand that if you are swing trading, it's very rare that you're going to get out in a matter of hours. Sometimes it does. Sometimes the market is going to do that for you, but those trades are generally going to be in for a little bit longer. So you really need to put your emotions aside and let that play out. If you want to trade more frequently and you have more time, there's nothing wrong with actually scalping and swing trading the same trade, right? So you can have your big entry short and have a good long-term target, but there's nothing stopping you going to the smaller time frame and actually scalping off the moving averages as well. So it's not really double dipping as long as your risk is right. And it does give you many, many opportunities. You can see even there, the moving average touches on the way down, having dynamic resistance as your entry point is a very, very effective method. And it happens no matter how sharp a market is falling. Most of the time, you will find a time frame that will give you these entries. And that's why we always say they're the quality entries, because that's where the market really shoots off.
Yeah, this is the best one as well, because you already had the 1 and the 2. And as I say, a lot of the times the 1, 2 on dynamic resistances, Ty, once you've seen that reoccurring event, it's likely that reoccurring event will continue. Now, what happened is it accelerated away. It's probably overextended now, but that's a different lesson for a different day. But when you see this type of movement and accelerates away from it, oh well, that happens. Then there'll be a different one. We saw the 1, the 2, this is the 20 on the 4 hour. So obviously on the 1 hour, it's more like the 50. And then that became the new opportunity moving average. Things change in the market, but you can be dynamic for those pullbacks. So understanding the dynamics, we've gone through that quite a lot today. We've gone through what we want to be doing in terms of criteria, recognizing things like range-bound markets, then recognizing movements out. 1, 2, 3 trading swing style is excellent, where we have multiple resistance areas becoming support. Here we've got a series of higher lows coming into this break. I've shown this slide before, a cross of the 20 and the 50, and a beginning of a new trend. And this was certainly a great movement up. It doesn't involve you doing that much in the charts. All you're going to be doing is checking the daily, checking the 4 hour, and making sure that you're aware of where the weekly and the monthlies are. For swing trading, that's all you need. Once you've identified these timeframes, and you will see this type of thing on a 4 hour, you can then dial into the smaller timeframes and look for entry criteria and look for reasons to be in them. But the general scan is only going to be daily 4 hour. You'll set alerts, and you shouldn't be spending more than an hour in the charts a day. And I think you can refine it down to 45 minutes to half an hour if you only stick to maybe 10 to 20 pairs, which is probably where you want to be as a swing trader, isn't it, Ty?
Yeah, and I think don't underestimate how many trading opportunities you'll get there. Like even 10 or 15 pairs, if you understand them intimately and understand their movements and get familiar with what they do on a daily basis, you've got to remember that every single pair gives you maybe 5 or 6 different time frames that you can effectively trade on effectively the same pair. So that really multiplies your opportunities. From 15, you're potentially looking at 45 different opportunities. So it can definitely play a very, very big role. But I think what we talked about earlier is really, it's a real takeaway. And if we were looking at key takeaways from today, understanding the movement of the market is a very, very important gauge in what's going to be either your success or failure as either a swing trader or a scalper. And understanding the differences between the two. I know Thomas touched on it earlier, but having that discipline Another question people ask is, which of those emotions do you really want to be feeling? Like he brings it up every single week, that slide, and there's about 18 of those smiley faces, and we get asked a lot, which of those emotions should you be focusing on? The truth of the matter is none of them. You shouldn't actually be focusing on any of them, because emotion should be left at the table when you're trading. It's probably the number one rule. And it's amazing how many traders we come across that actually have got good strategies and actually are very, very capable of reading the market. But what they're not capable of doing effectively is actually having the discipline to follow through with what is otherwise a really good plan. And that comes down to those emotions. None of those emotions are good. You don't want to be feeling any of them. Even though you will, you don't want to be. You need to be taking them out of your trading. And you probably need it printed on a chart on your wall and look at it when you are placing a trade. Make sure you're not feeling any of them, and then go ahead and place a trade. I think that's probably the best way you can put it.
I've told people to laminate tick boxes just so that they have to, every single time, they've got to tick that box before they make the trade decision. And that can be a trigger point to say, okay, well, I better think about what I'm doing. There's a question coming in here, Ty, and I think you answered it, but it says, hi, Ty and Tom. What should be your trigger that a currency pair is oversold like EG or overbought like EU? And Tyrone said here, once it hits a major support resistance zone on a higher time frame is a good start. And that's certainly the way. So let's say you had structure over here and then it moved down and a market was doing this and then something went like that. Now, it'll usually stop at this point, but then there's sometimes called what they call the excess phase. And this can get a lot of traders. So that's where it goes hyperbolic on that last point, spurts through, and then it will actually crash or move in the opposite direction after. This bit here often catches retail traders because they think, oh, I shouldn't have gotten out here. I'm stupid. You're not stupid. You made the right statistical decision, because statistically speaking, this is the most likely to act as resistance. The problem is the market will often extend into this excess phase, and when it hits this is where it traps everybody into going re-long, and then it will go the opposite direction. Just always be very confident in your support resistance zones. The other way that you can tell is that, let's say it's a two step forward, one step back, two step forwards, like that EG. What was happening there? It was hitting a moving average every time it pulled back. Then all of a sudden it went through, and it was obviously the opposite direction, but it went kind of crazier. And instead of using the 50 moving average for the pullback, it used something else. You'll notice that's what happened on Bitcoin recently. That's what happens on penny stock sometimes. That's what happens on these things. So they go into that excess, that extreme phase, and that's usually when you know it's in the final one, unless it's Tesla, Tyrone.
Yeah, that's right.
Until recently, Tesla was unstoppable.
True that. We've got another question here from Christian, actually, about martingale strategies and do we use them as part of our trading? Okay, good question. And look, I'll tell you the thing about martingales. They are fantastic when they're used correctly. They're just like leverage. Okay, if you use leverage to your advantage and are sensible about it, a martingale effect can be very good. But you're not going to like what I say about how to use it, because it's not going to meet what most people want to use it like. The best way to use a martingale system is like this, especially when you first start trading. When you first start trading out, and for beginners, they don't like taking losses, right? As a rule, no one really likes taking losses, but beginners in particular do not like taking losses. So if you want to use a martingale system and understand the power of how it works, the best thing that you can do is say to yourself, I'm going to risk 1% of my account per trade, but it's going to be martingale. So my first attempt at the trade is going to be 0.25%. If that trade fails, I'm going to try again, and I'm going to go 0.5%. And then you leave it at that and let it play out. If it fails again, you do not enter any longer. Now, the reason I say that the problem with martingales and the trap of martingales is that you will continually do it and average down and double up, triple up, quadruple up, and you refuse. What it teaches you is a refusal to accept that the market has actually gone the wrong way on you. Okay, and it brings about one of the biases that you really want to take out of your trading, which is the never wrong syndrome. And that's the problem with martingales. If you want to use it because you want to get your confidence up and get more trades right than wrong, which is fine, especially when you're first starting out. Do it in a way where you're not risking more than your initial risk had you traded it at 1% in the first place. If you do it like that, it's perfectly fine. Now, I know a lot of people are not going to want to hear that because they don't want to take a loss at all, but that's not the way to treat martingale, because martingale will be the destruction of your account. That I can assure you. We've seen it all too often. But when used correctly, it can be a really good way to get your confidence up and really not risk any more than you would have in the first place. And I think that's probably the key.
Yeah, it is about, everything's about risk management, the psychology, as Tyrone mentions, and martingale can get you in some massive danger if you don't know what you're dealing with. So stochastic indicators, MACD indicators, they can all be bought into your swing trading. One of the things, let's say we're swing trading on the direction up, will you, and the trend is up. Now, a good swing trader will generally follow the trend unless they've got a structure telling them otherwise that they believe is the beginning of a new trend. Now, if you're selling here, you're not really swing trading you're swing trading the opposite way. But if we're looking to buy, let's say previous resistances acting as support, etc., and this we deem to be a good area, you can use stochastic. It can move into the oversold area and we can take it potentially long. Now, would I put that much stock in something like this? Would I consider this a very strong indicator? No, but it is very difficult for a market to oversell on the time frame when it is in a direction trend. So if it is oversold, it's a perk or a bonus attachment. Usually it's going to be the resistance becoming support, the moving average, the fib, all of those things that we'll put in front. But stochastic can also be used as one of the reasons to get in and out of the trade. So really, to sum it up, we want to go stochastic, MACD, and RSI are all okay in swing trading, and they all will make some sense if you use them in the correct ways. But if you want to find out more about them, we have done them in the past. Now, Tyrone, I believe today there is also a Q&A at the end. And if you've enjoyed this webinar so far and you've enjoyed today's session, please let Pepperstone know. And also please let Pepperstone know some of the things you want to see in the future, because we are looking for more feedback on some of the things that you want us to do. We're always looking to improve these things and to offer you, the people, what you want, of course. So
Absolutely.
What other market conditions do we want for swing trading? Generally, Mondays are actually pretty bad for swing trading. I would almost consider taking them out of trading, because while right now in the market, Mondays aren't too bad, they often have what we call fake out days. So if you're trading currencies, especially let's say the euro or the pound in the Asian session, and it hasn't even opened to a London session, a European session, or a US session yet, you can get a lot of fake outs. So be careful of that in swing trading. Obviously, be careful of key news, non-farm payrolls, something that I would stay away from. But traditionally, another reason why part-time traders use swing trading is because they don't have to worry about as many news events. If you're a scalper, you're constantly stressed. Or the CPI is coming out, the GDP is coming out, something else is coming out. You worry because it might move at 10 pips. That's not good for you, but the thing is, it's okay for the swing trader. So generally speaking, you'll be fine in those types of situations. Tyrone was mentioning this before in terms of risk management strategies. And Tyrone, we'll answer some Q&A now, but I just wanted to say we've been around now for 10 years running our education courses, and we are doing our 10-year anniversary. Technically hasn't started yet. It'll start next month, but we thought that we would post this here. Just if you're interested in joining, or you like some of the things we talked about today, you want to take your trading to the next level, we've designed a masterclass for technical analysis. We also have a stock trading course, but a masterclass for technical analysis. There's a private chat room and Discord community in there, and it's perfect for part-time traders. That's one of the things we really focus on with a small amount of time. Every single system that we talk about and every approach that we talk about is about making as much sense as possible with as little time input as possible, isn't it, Ty?
Absolutely, no question about that. I've actually also posted a link in the group chat for the webinar that's about to start. We have had a lot of questions to analyze some individual pairs today. Look, we do that every week on a weekly basis at 9 p.m. Melbourne time, but we're starting in 15 minutes on that one. So I have posted a link, so it's free to join if anyone would like to join. If you haven't already registered, the link is in the chat room there, And yeah, feel free to join us in 15 minutes where we do a live market analysis and apply a lot of the learnings that we've talked about in this particular webinar in that. So the other thing I will say too, apart from all of the good things that are coming out of the 10-year anniversary sale, we've also got in that Discord room, a lot of people aren't aware of this, but we've actually got a trading competition that runs every single month where we've got a live account where the best trades of the day are actually posted and traded, and the best one is actually picked and traded in at what is currently a $20,000 live account. Now, at the end of that month, whoever has contributed to the most amount of trades that have been successful actually takes all of the profit for that particular month. So as the account gets bigger, the profits are going to get bigger as well, and there's going to be some very happy traders. And one of the benefits of it is, of course, that you can actually leverage off some of the trades that are being posted every single day and ascertain whether they actually meet your requirements and take them in your own account as well. So aside from the competition where you could actually win some really good money, you can also actually take advantage of some really, really good trade setups from tried and true methods, because the majority of the community have done the course and they're really talking and applying the same methodology that we're talking about here. So a really, really big plus for anybody who hasn't done it.
Okay, where are the old webinars? Got a few questions. They're on Pepperstone's YouTube. We also do run one that we just said after this. It'll start at 9 o'clock. So if you want to join that, and we've got those ones backlogged on our website. But we're going to go through some questions here. Cheers, I use a combination of MACD, stochastic, RSI, and support resistance lines. Definitely informative, says Christian Bernard. That's good. Or Bernard, sorry. That's good. They're all excellent. And they've got some other questions here. If a price is far off the area of value at daily, would you still trade opportunities present on the 1 hour charts? Is there a risk of price sharply snapping back? This is from Rohan. So basically, if a price is far off the area of value, so when you say area of value, are we talking about the market has moved up, let's say through a point of resistance? Let's say that was a great point of resistance. It's like here, and you believe it's going to stop here, but you didn't get involved in it, let's say on the close or on the pullback or any of those points. You're maybe here right now. Is there a risk? Of course. Is there an opportunity? Yeah, go down to the moving averages. Look at the smaller 1 hour, because you've recognized all this on the daily and the 4 hour, traditionally where the swing is. There might be a 1 hour where, as Tyron mentioned before, it's pulling back 2 steps forward, 1 step back throughout that in the participation phase towards the resistance. So it could certainly present opportunity, but there's always risk with all these types of trades.
Definitely. I had a question earlier about, I can't remember who it was, so sorry, but the question was, how do you spot a fake out and how you deal with that? So the way you deal with a fake outs can be difficult to deal with, make no mistake. Like, there's no real secret to, trying to spot them. What you can do is apply as much knowledge as you can to what you're actually seeing. Now, generally a fake out is going to basically close below that resistance or support. And fake outs quite often happen when you jump the gun and don't wait for the confirmation close of a key candle. And I mean, look, and we're talking about serious time frames like, say, 4 hour and 1 hour charts here, right? Not like 5 minute and 15 minute. If you're going to trade those sort of charts, you're going to get a lot more fake outs. There's no question about that, because they could easily close above a serious level and realistically come back and snap back into the zone. The difference between a daily chart and, say, even a weekly chart for that matter, is that a daily chart allows every market in the world, every time frame in the world, to have a view and a say into where that direction is going to be. And that's why the daily is so important, because it incorporates the Asian session, the European and London sessions, the US sessions before the candle closes. So if it is going to have momentum shift and close below a level, below a resistance level or above a support level, it's got 3 or 4 very, very important markets determining the outcome of that. Whereas, of course, a 15-minute candle is only going to have who's looking at the charts at that time. So stick to the bigger time frames when looking for fake outs, and wait for the all-important close to make sure that it has closed below it. If indeed it closes above it, then you've got to trade it. And if it fakes out, well, then sometimes you're going to be a victim of circumstance. But what we find is the bigger the time frame, the more reliable the signal. Okay.
All right, Tom, I'm going to do what I call the rapid minute, which is really quick responses to these questions, just so they get answered, because they are good ones. How do you look at support resistance levels, horizontal lines versus trend lines, angle lines? Which one is more important for swing trading? Horizontal lines all day long. You can use trend lines, but you'll end up finding you draw some really weird trend lines. So I think
They're very
horizontal is
subjective.
best.
They are
Super subjective. Which is the best? What is the best practice moving average combination recommended? 20x 20 EMA, 50 EMA, 200 SMA. Does ZAG US dollar obey support and resistance? It does, but sometimes it spikes around with the economy. So look for very high quality setups on that one. And do you give your setup a second chance after a stop hunt? You certainly can. The traditional stop hunt might look like this. You got the stop there, and it's like a wick. Looks like that. Now, if it's that type of one, yeah, you can give it another chance. If it's not that kind of one, maybe not. But if it does instantly reject and it's a fully fledged stop hunt and you still think it makes risk reward, if you take your emotions, leave them at the door, you can certainly give it another shot. But just remember, where's your stop loss going to have to be now?
Yes.
Above the stop hunt.
and most importantly, Nicholas, only one chance. If it fails the second time and it goes on you again, do not enter a third time under any circumstances.
Pretty much, yeah. You don't want to just keep on adding to those positions. All right, everybody. Well, thank you so much for joining us. Enjoy, hopefully, the recording. If you want to go through some of the things we talked about, do that Q&A at the end. The feedback does help us out and helps Pepperstone get better stuff for you guys and for the future, I guess, of your trading journey. So we'll see you in 2 weeks' time or in about 9 minutes at our one. Talk to you soon. Bye for now.
Thanks, everyone.